Let's continue on with step 3 of the accounting cycle. Choose the account names that will be used. Accounts are common subgroups of financial reporting elements that are used to accumulate, that means to gather together, the impact of business activities. Only through the use of accounts can the accounting system produce financial statements. Why is that? Because if stakeholders only received total assets, liabilities, equity, revenue, and expenses without any additional information of what makes up those totals, they would not be able to make informed decisions about their interactions with the business. Total assets of 1,482,650 does not tell you if those assets are going to be converted into cash, such as accounts receivable, or if they will be used in future to help generate revenue, such as equipment. The use of accounts allows the business to break up the financial reporting elements into different subcategories, such as cash, accounts receivable, inventory, long and short-term liabilities, the different expenses, etc. That level of detail is what stakeholders need in order to better understand the business's financial position and profitability. For more information about common account names and their definitions, please see my videos on transaction analysis with account names. Let's continue with our example, but let's do it looking at the accounting equation. Remember, a business provides consulting services. The business has provided services to the client, which we agreed increases revenues, and then bills them, sends them an invoice for $220, which increases the asset. We've already determined this in step 2. The asset account, which represents a business's right to collect cash in the future, is accounts receivable. The revenue account, which represents the provision of a service, is called service revenue. Moving on to step 4. Record the transaction into the T accounts. T accounts are also called ledger accounts. They are a graphic representation of a general ledger account. When I organize my T accounts, I always do it by financial reporting element. If you have not seen my video on the secret of debits and credits, watch it now and you'll better understand what I'm doing. On every single T, the name of the account is placed above the T, sometimes along with the account number. T accounts are micro representations of the balancing of the accounting equation. Debits, or DR for short, always go on the left side of the T, and credits, or CR for short, always go on the right. Remember, see my video on the secret of debits and credits for more information. The purpose of the ledger accounts, or T accounts, is to record and summarize the impact of every transaction on each of the individual accounts by account name. The balance of the T or ledger account at the end of the period is transferred to the unadjusted trial balance and allows for the creation of the financial statements. The recording of a transaction in the T account is called posting. Continuing with our example of the consulting business, we would record a debit in accounts receivable T account of $220. We would also record a credit to the service revenue account because revenues, which become part of equity through profit and retained earnings, increase through a credit. Moving on to our next step. Step 5. Record the journal entry into the general journal. The general journal is a chronological listing of every single transaction. Each journal entry includes the date, the titles of the accounts being debited and credited, and a short narration of why the journal entry is being recorded, and finally, the amount of the debit and credit. Account names are always listed in the following order. First, all the debit accounts, and then, indented, the credit accounts. Continuing with our example, the general journal would show the following. We don't have a date, so we simply use the transaction number. Then remember, place all the debit accounts first, then the amount, then move on to the credit accounts and indent them, then the amount. Notice that we are copying what we did in the T accounts. In the T accounts, I debited accounts receivable for $220. I am debiting accounts receivable here for $220. Also, note something interesting. In the general journal, the balancing scale is duplicated. We are automatically duplicating what we did in the T accounts. I now provide the explanation. Again, note that if there's no date, we simply use the transaction number or indicator. Also, I'm going to reiterate this. Debit entries are recorded first, followed by credit entries which are indented. All the accounts which are debited would be listed first, even if there are more than one. Finally, it is not necessary to place these two things in front of the account names. That can be omitted. I simply do it automatically. We have just journalized this transaction. Moving on to step 6. Produce the unadjusted trial balance. The unadjusted trial balance is an internal worksheet produced for two reasons. First, it ensures that all the debits for all the accounts equal the credits for the other accounts. Second, is to simplify the process of recording adjusting entries. Adjusting entries will be covered in a future video. This is an example of an unadjusted trial balance. First, there's a title for both the company and the worksheet. The date is the same as the dating on the statement of financial position, a point in time. The headings are simple: debit and credit. Sometimes you might see a heading called account name, but that's not required. The accounts are in reverse financial statement order, starting from current assets and ending with expenses. You'll notice current assets, non-current assets, current liabilities, non-current liabilities, equity, revenue, and expenses. There are no subtotals or categorizations of the account. The total at the bottom indicates that debits are equal to the credits. Remember, the purpose of an unadjusted trial balance is to aid the preparer of financial information, providing the balancing of debits and credits, as well as simplifying the process of recording the adjusting entries. Does that mean the trial balance is perfect? Absolutely not. If debits equal credits, then the unadjusted trial balance is in balance. This confirmation of the balance between debits and credits does not mean that there are no errors in the accounting system. There are 4 errors that would result in debits equaling credits, a perfect balance, but the accounting records are wrong. What are the 4 errors that can occur that result in debits equaling credits even though the information is wrong? First, transactions may be recorded in the wrong accounts. For instance, the accountant debits cash when they should have debited accounts receivable. Now both cash and accounts receivable balances are wrong, but the debits equal the credits. Second, transactions are recorded for the wrong amounts. Here the entry is made for $940 when it should have been made for $490. Again, both accounts are wrong, but the debits still equal the credits. Third, the accountant omits a transaction altogether. This means that both accounts are either under or overstated, but the debits still equal the credits. And finally, 4, entries are duplicated. In this case, the company makes the correct entry, but then the entry is made again, perhaps by another person. Debits still equal credits on the unadjusted trial balance, even though the amounts are wrong. Remember, the purpose of the unadjusted trial balance: check debits and credits and simplify the process of recording adjusting entries, but that doesn't mean it's perfect. Let's just reiterate the steps in the accounting cycle. 1. Read the business activity and decide if it is a transaction or an event. 2. Analyze the transaction using the activity analysis questions. 3. Choose the account names that will be used. 4. Record the transaction into the T accounts. 5. Record the journal entry into the general journal. And 6. Produce the unadjusted trial balance. There are 5 additional steps in the accounting cycle. These additional steps will be covered in an upcoming video. Thank you so much for watching these videos. I hope you can join me in the next ones.